Welcome back. This is Jacob Milliken, owner of 9M Investments, and today we're going to be going through an investment case study. In this case, we're going to go through a structured growth note that I recently placed with some of my clients. And so first, what is a structured note? A structured note is essentially a fixed income investment that has an option strategy placed around it. And what we use it for in different scenarios, it can be income, it can be growth, but really where it gets its funding from is through the option strategy on that. So whether it be individual index or individual company, we're using the volatility in the options market to kind of drive the growth or the protection that we can get around that investment. So in this case, with a structured growth note, we're looking for an index that is going to grow over time. And we want to add some protection around those investments. When it comes to building a portfolio, again, we want to make sure that we can have that upside of our investments growing, but for a lot of people, especially my retiree clients, we also want to have some protection to the downside. So let's jump into this particular note that we used that was traded last month in April. So in this example, this was a note that was put together by JP Morgan. Again, trades like a fixed income note. So it has a term, it has a 4-year term. The underlier of what that investment is based on is the SPX, which is the S&P 500. And then the protection on that note is a 10% what they call a hard buffer. And so what that means is no matter what happens over this time frame, you'll have a 10% buffer. So at the end of 4 years, if the S&P was down 10%, we're at zero. If the S&P 500 was down 20%, we're down -10. So that 10% buffer is what we get there. Now, do keep a note, one of the reasons that we do these buffers is, again, kind of give you peace of mind, give you some protection. But over a 4-year period, there's only been a handful of times where the S&P 500 has actually been down, and there's not been any times where it's been down over 10% over a 4-year period. So again, this is more of a peace of mind, but we want to make sure that we take advantage of that and give peace of mind to investors. The nice thing about this particular one, the volatility that was happening around April or the middle of April last month, is we get 2.1 times to the upside of the S&P 500. So at the end of year 4, we hope that the S&P continues to grow. Historically, the S&P has been about 9.5% per year. Obviously, that's not in a straight line. So whatever the return is at the end of the 4-year period, we're going to get 2.1 times whatever that may be. So in this example here, let's say it was only up 10% over a 4-year period. Well, you know what? We're going to be up 21%. Again, that 2.1% multiplier on this type of investment. Now, kind of give you an idea of what that looks like so far today. So this note traded on April 17th. So far as through yesterday, which was May 21st, the S&P 500 was up 5.59%. If this note was maturing tomorrow, we would get 11.74%. So again, 2.1 times whatever the return is on this note. So it's a way to, again, not only give us this hard buffer, this 10% buffer that we have at the bottom here, but we're going to multiply whatever the return is over the long term. So, hopefully at the end of the 4 years, we've had a really good market run. Whatever the market's done, we're going to get 2.1 times that. So really a way to boost your returns and make sure that you're kind of keeping ahead of the game. Where this is very interesting, again, it's hard to do. But there are some things that you have to kind of make sure that make sense for you as an investor. So this 4-year term, if you don't have a 4-year window, this is probably not the type of product that you want to be doing it. But if you're going to have S&P exposure in your portfolios, and like most of us do, whether that be 10%, 15%, 20%, 50%, whatever, your portfolio has, maybe adding a piece of this to help boost that income over time is a great way. And then also, obviously, give you that buffer, if something happened or went sideways. So really a great way to boost the gains, whatever happens over the next 4 years. And then from a downside protective, really give you some peace of mind that, at least that S&P 500 exposure, even if it goes down from here, we have some protection to that. So again, really hard to beat. If you have a portfolio today that has, let's call 25% S&P 500, over time, let's say it does 10%. So yeah, into the 4 years, you've grown that piece of your portfolio 40%. With a note like this, you're able to double that up. So a really strong way to not only get the what they call the beta from the market itself, but creating an alpha scenario where you're getting 2 times whatever the market does. So a very, very strong way to get performance where otherwise would be very, very hard to match that. So that is all I have on this today. If you have any questions or maybe how this could, an investment like this could fit in your portfolio, please reach out, because these are the types of things where I help with my clients every single day of the week. So I hope you have a great day, and we'll talk to you soon. Bye.